Quick permission slip before we start. You don't need to already know the answer to this, and you do not need a spreadsheet open. Just think about it with me. If rent goes up 3% and expenses go up 6%, does the deal still work? If you're hesitated, that's a good sign. I want to say something real before we go further. Most people don't miss bad deals because they're reckless or they're being bad at math. They miss them because they're responsible and trying to do the right thing. So if you ever felt unsure about a deal that looked fine, this isn't a judgment, it's a conversation. I remember sitting with one of my own deals late at night, nothing dramatic, no crisis, just refreshing the P&L and thinking, why does this feel heavier than it should? That's a lonely feeling because nothing is technically wrong, so you don't even feel justified worrying. And that's a weird place to be because nothing is technically wrong. If someone has asked me that day, I would have said the deal was fine, but it didn't feel fine. And that moment, that quiet discomfort is what we are going to talk about today. Not panic, just a point where a deal slowly stops giving you room to breathe. Let's walk through a normal deal together, and I'll show you the moment it stops growing, even though nothing looks broken. This is the kind of deal that most of us feel good about. Average rent about $1,480, expenses ratios mid-40s. Nothing aggressive or fancy. This is the deal you point to and say, I'm doing this the right way. But 6 months in, nothing is wrong. Occupancy is steady, collections look fine, no tense call from the lender. But if I'm being honest, this is usually where I start checking the P&L more often. Not anxious, thoughtful, not because I'm panicking, just because it just feels tighter. And when a deal starts to feel tighter before anything shows on paper, it usually is because the margin is thinning. It's not disappearing, it's just narrowing. And when the margins narrow, even small changes start to matter. That's why the next part catches so many people off guard. Insurance renews. It was underwritten at about $910 a unit, and it comes back closer to $1,260. My first thought wasn't, oh my god, the deal is in trouble. It was, okay, it's tight, but we can handle it. And honestly, that reaction makes sense. Then a few months later, taxes got reassessed after the sale, and that's another 50-something thousand. Still no emergency and still no disaster. And this is usually where most of us nod and keep moving. This is the part I missed the first time that I went through this. The rent assumption didn't change, but the cost of operating the building quietly moved up, and it stayed there. That higher number doesn't just go away the next year. It becomes the baseline you're building from. These costs don't roll off the next year. They don't normalize. They're just there now. Then something subtle starts to happen. Rent growth stops feeling like a bonus and starts keeping the lights on. Nothing fails, nobody was reckless. The deal just quietly shifted from building a momentum to just holding your ground. And if you're watching and thinking, this feels uncomfortably familiar, good. This is where clarity usually shows up. On paper, rents are still growing. Market reports say it, brokers repeat it, we're told we're under market rent. And at first, you want to believe it. But then the leasing does what the leasing always does. 1 month free there, quiet renewal discount there, a fee that suddenly disappeared just to keep a good tenant. And this is usually when it clicks, because asking rent is what we hope for, and effective rent is what actually shows up. This is the sentence that I wish I'd used earlier, especially when a deal still looks fine. When costs grow faster than what you actually collect, the deal is shrinking, even if NOI is still looks okay. And the reason this keeps catching people off guard is simple. Expenses don't move together in one direction anymore. Taxes follow policy and budgets, insurance reacts to national losses, labor shifts locally, rent comes and goes. But once costs move up, they rarely can't come back down. And this is usually where the deal quietly forks. Not on paper, not in headlines, but in how you start thinking about it. One path is hope. Rents will catch up, expenses will settle, this is just a phase. And I get why that's tempting, because hope lets you stay still. The other path is control. You protect occupancy, you lock what you can, you preserve flexibility, and even if it costs some upside. It's not exciting, but it's steady. And I'll be honest, the hardest part for me wasn't the numbers. It was realizing I was quietly waiting for the deal to save itself. Not because I was lazy, but because admitting that shift meant I had to change how I operated. And that's uncomfortable because it feels like giving up upside, even when you are really doing is protecting yourself. Here's the part most people may miss. There is a phase where the deal hasn't failed, but the equity already has. Effective rents stall, expenses stay high, and from here on out, you are not really creating value anymore. You're choosing which losses to accept. So let's come back to the question that we started with. If rents go up 3%, and expenses grow 6%, does the deal still work? The better question is, however, how long does it work before the deal stops giving you room to breathe? Most investors talk about rent growth, but what actually matters is how long rent can stay ahead of your costs. Because once expenses move up faster than rent, the deal doesn't explode. It just slowly gets smaller. And that's the part we often miss.